Tim Lawless, thank you very much for joining me.
Thanks, Steph.
Tim, we've seen property prices surge in October. What can we attribute that to?
So there's a whole bunch of factors here, and once again this surge is very much attributable to, well, Melbourne for starters, and then Sydney. Melbourne's overtaken Sydney as being the strongest performer, but of course it's around lower interest rates, better access to credit, some certainty returning to the market post-federal election. But of course, if it was just that, it would be everywhere would be seeing values rising really quickly. So Sydney and Melbourne are quite different in the sense that these are also the cities where jobs growth is the strongest, where unemployment's the lowest, where generally the economic conditions and demographic conditions are healthier than other markets. And I think it's that combination of just the strong fundamentals plus a lot of the stimulus that is seeing those markets catapult ahead of other areas. But the interesting thing about the October results and the month leading up to October was that we are seeing a bit of momentum now gathering in the smaller cities as well. So we are seeing values rising over the last month across every city apart from Perth. And over the past 3 months, it was every city apart from Perth and Darwin. So a bit more a broad-based improvement in values.
The RBA this week left rates on hold in November. Do you see rates getting lower?
I think we're probably in for one more rate cut, and I think that will be early next year. Of course, the RBA is getting very close to running out of ammunition here. Most economists would think that a 0.5% cash rate is as low as they'd be willing to go before we start seeing some unconventional policy coming through. The big question about housing markets, though, isn't really the cash rate, it's mortgage rates. And the last two rate cuts, we've seen not the full amount being passed through. And chances are, if we do see rates coming down another 25 basis points in, say, February next year, we'll probably only see about 10 to 15 basis points being passed on to mortgage rates. Clearly, that's positive. Lower rates are always going to be stimulatory, but I think we have seen the best that lower mortgage rates are going to deliver to the marketplace.
So are we heading back into boom territory with prices and where they're going?
Well, at the moment, absolutely. If you look at the rate of growth in Melbourne was up a bit more than 2% over the month in October. Since the market bottomed out in May, values are up by 6%. This is actually a faster rate of growth than we saw over the previous growth phase, around between early 2012 through to 2017. Melbourne's monthly growth rate hasn't been this high since early 2009, since late 2009. So we are seeing very strong conditions in Melbourne. Sydney values, the past 2 months were up 1.7%. That's getting close to where they were peaking out at back in 2015. So chances are we could start to see, well, if this momentum continues, or this level of gain continues in the housing market, it won't be long before the previous correction is actually fully recovered and we start to see both Sydney and Melbourne breaking new ground for housing values.
Does that concern you at all?
Well, there's two ways to look at this. For a homeowner, that's great news. You're becoming more wealthy. Hopefully that gives you some confidence to get out there and spend more. That's exactly what the Reserve Bank and Treasury want to see, is households becoming wealthier and spending more. That's a big part of our economy. But for those people who don't own a home, this is becoming even more challenging. First of all, housing affordability did improve during the housing downturn, but Sydney and Melbourne really still stand out as being highly unaffordable markets. So for first home buyers, who are currently quite a large proportion of activity, as there's stamp duty concessions and exemptions in place, and the affordability improvements, I think we probably will start to see first home buyers getting pushed out of the market, not just by by higher prices, but also by an increase in investment activity.
The RBA earlier in the year wrote a paper on consumption and how our kind of mortgage debts are preventing us from spending. Do you see this as potentially getting worse?
At the moment, it looks like household debt is starting to level out. The data's quite lagged. We can only see official data up to June at the moment. And it's clear we are seeing more borrowers paying down their principal. Interest-only lending and interest-only loans are now a much smaller proportion of the market. So that's one of the reasons why the RBA credit aggregates are tracking at such weak levels. We're seeing a lot more debt pay down, it seems. But in the same sense, when you look at the dwelling or housing, debt levels relative to household incomes, it's still tracking at around 190% based on the June numbers. 70% of that debt, or roughly 70%, is housing related. So chances are, as we start to see credit opening up a little bit more, we did see quite a rebound in housing finance commitments on the most recent data. Chances are we could see housing related debt rising even further. That's probably not that big an issue when mortgage rates are as low as what they are. Clearly, households have demonstrated they can service this level of debt, but the risk is, that the RBA is pointing to, is that it takes much longer for debt levels to reduce than for interest rates to rise or housing asset values to fall. And that's probably the danger here, is that we have a heavily burdened household sector, a debt-burdened household sector, which is fine when interest rates are low, but when interest rates do eventually rise, or there is some shock, or households meet some sort of a pause in their income creating capacity, either through illness or having another child, something like that, then it does leave the household sector quite exposed.
And what about credit growth? APRA has only recently relaxed rules for property investors. Do you think they might need to reapply the handbrake at some point?
So I think APRA wouldn't act just to keep a lid on house prices. I think APRA would wade into the marketplace if they did see a real rise in speculative activity, for example. At the moment, investors are still only about 25 to 26% of mortgage demand, which is, they're underrepresented. Normally, you'd expect investors to be about a third of mortgage demand. When APRA weighed into the marketplace on the last round of macroprudential measures, investors were about 43% of mortgage demand. So you can understand why they did that. Another reason we could see some intervention is if we do see household debt rising further from here. And I think the intervention from policymakers would probably be quite different from what we saw. The last couple of rounds of macroprudential were a 10% speed limit on investment credit growth, and then a 30% origination limit on interest-only lending. This time around, we might see the regulators being more focused on things like debt-to-income ratios, firm limits on lender exposure to debt-to-income ratios above 6 times, or it could be around minimising high LVR lending, just as what we saw in New Zealand. So we're still seeing in Auckland, in New Zealand, if you're an investor, you need a 40% deposit to play in that market.
Wow. That could be a very different market here.
But what we've seen in the past, as soon as we do see these levers being pulled, the effect is virtually instantaneous on market activity. Generally speaking, in Australia, you need finance to access the market. And if we did see finance becoming tighter or tighter controls, you'd have to expect that's going to impact on the market.
What is the worst case scenario here? Do you see a bubble bursting?
If you look at sustainability in the housing market, generally a sustainable growth rate would be in line with wages or in line with household income growth. So the last couple of years, we've seen housing values falling against a backdrop of incomes slowly rising. And now it's the opposite of that. Well, it's more than the opposite. We're seeing incomes still slowly rising, but housing prices once again rocketing higher. So in that sense, this isn't a sustainable housing market. You'd have to expect that affordability constraints will start to impact on the market. We're already seeing interstate migration rates really picking up into much more affordable markets like southeast Queensland. The tide seems to have turned in WA with more migrants or fewer people leaving and more people arriving back into WA. And I think part of that, sure, it's around economic improvements and more jobs available, but also just the sheer affordability of housing prices in some of those markets.
And just lastly, what is your outlook for property in 2020?
Well, so far the trend is gathering pace. I think through to the end of 2019, we probably will see this pace of growth continuing. It's hard to see any sort of intervention in this time frame. And carrying into 2020, I wouldn't be surprised if some of those smaller markets that have generally lagged behind Sydney and Melbourne might actually start to come to the attention of investors. That's generally where capital gain prospects are probably stronger, at least over a medium to long term, where yields are higher, where the affordable entry point to the marketplace is much more achievable. But without any intervention in the market, say from regulatory intervention, it does look like we're set for a fairly strong entry into 2020.
Tim Lawless, thank you very much for your time.
Thanks, Steph.